Oh, that's not what we want. Hello, TV land. Hello, BBC. We are live and back again with another Dividend Happy Hour. What's up, guys? How's everyone doing? Happy Friday. Welcome back to another live stream. I'm stoked for this one. I've got a feeling, maybe it's just gas, but I've got a feeling this is going to be a pretty good live stream. It might, in fact, be the best one yet. So thank you for joining me for it. I'm happy to be here with you guys. Happy to be back with another live stream. Hope everyone had a fantastic week. I hope things are going well in your portfolios. Let me show you what I got cooking up in mine. Let me see where the portfolio value is. So let me add this to the screen. Taking a look at my dividend portfolio tracking spreadsheet, which you can start using for free. There is a link to download this bad boy in the description of the video. Right now, guys, I'm sitting at about $109,800. Today was a pretty good day, a good way to close out the week. Yesterday was kind of a rough day. We saw basically this amount, about 400, 500 bucks. In the opposite direction. We'd lost some money, so we made that back, which is good. Still hovering around 110,000. I don't remember exactly where we were at the last live stream, but I think week over week it was pretty similar. So yeah, overall I'd say pretty good week. Actually, very uneventful in the portfolio. These last few weeks for me, guys, I haven't bought any individual stocks. I think it's been 3 weeks now in a row that I haven't picked up any. I've just been dollar cost averaging into SCHD, into VOO. I think I've got about 1,600 bucks in cash in the brokerage account ready to deploy. So trying to figure out the best way to do that. But man, things are pretty frothy right now. I don't know if you guys feel that too, but it's kind of how I'm feeling over here. But anyway, enough about me. How are you guys? How are all 45 of you in the stream? Let me know a few things here. Well, actually, before we get to that, we've got to take care of some business, guys. Sorry, getting ahead of myself. Grab whatever it is you're sipping on. I just got me some water here. You guys like to make fun of me for this cup. The reason I use this cup, though, is because it holds like 40 or 50 ounces of water. So it really helps me drink a lot of fluids. So that's why I rock with it. But grab whatever it is you're sipping on, guys. Here's to you. Thank you so much for tuning in tonight and hanging out with me. That's number one. Number two, here's to the dividends. Here's to the pursuit of that sweet cash flow, because that's really why we're here, right? To talk about some dividend stocks. But nonetheless, cheers. Now, with that said, let me know a few things here in the chat. Number one, I want to know, what did you buy this week? Which stocks did you add to your portfolio? What is looking good out there to you guys? Number two, what are you sipping on tonight? What did you bring to drink to the dividend happy hour? Let me know that as well. Number three, I want to know if anything cool happened in your guys' portfolios this week. Maybe you hit some special milestones. Some of you guys are probably sitting at all-time highs. A lot of you probably are, in fact. But maybe you hit your 100th share of SCHD. Maybe you are bringing in officially 200 bucks on average in dividend income. Any milestones, anything, any accomplishments that you want to share in your portfolio or outside of your portfolio, drop them in the chat as well. We'd like to share in that with you. But also number four, like buy assets here. Let us know if this is your first time tuning into the Dividend Happy Hour. In case it is, welcome aboard. I'm so stoked to see you in here. Typically, we do this live stream every Friday night, starting at 5 p.m. Pacific time, 8 p.m. Eastern time, and it's always a good time. It's pretty much just like, as you'll come to find out, it's pretty much just kind of like a random hour, just a hangout session. It's exactly what it sounds like. It's just a happy hour where we come together and shoot the breeze and talk about some dividend stocks. And with that said, in addition to those few things in the chat, and I'll go through and put some of this stuff up on the screen. Let me know if there's any stocks you guys want me to look up, any investing questions you have. That's what we're going to be going through in the stream tonight. But let's get caught up here in the chat and see what's going on. See who all we got in the building. I see Chris, Korean Cardboard, Fast Eddie's here, Fishy Man, Antonio's here. What's up, Antonio? Vasco's here. We got Craig in the building. What's going on? Andrew's here. Joey. Did I already say what's up to Marcus? I don't think so. What's up, Marcus? Pat is here. Good old Pat. Alfredo's in the building. What's up, ma'am? Yeah, buy assets in the building. We've got Midway Piper. What's going on? Sipping on some sparkling water and bought some Keurig Dr. Pepper. Nice. Yeah, so KDP just announced a merger with, what was the company? It's basically Pete's, the company that has Pete's. I think they have Keurig is no. That's KDP, not Keurig. Another coffee, like single serve coffee thing. I don't know, but basically the company that owns Pete's, they own a handful of other coffee brands as well. So they announced a merger, and they're going to be splitting off Dr. Pepper, or KDP, the new company, into two separate companies. One that's focused on primarily beverages, and I think another that's just focused on specifically coffee. So that'll be interesting to see how that plays out. Some other notable news I'm sure you guys heard: Walgreens has officially gone private as of this week. I think as of Wednesday or Thursday. So you can no longer buy shares of Walgreens on the stock market, which I think is a good thing. So I think we should rejoice in the fact that that's no longer an option. That's not an option that we needed, in my opinion. So yeah, pretty interesting week for dividend stocks. But let's keep going here. We got Chris, who picked up some VOO, Walmart, ASML, UNH, and CDNS. Nice. Korean Cardboard started a position in Hess Midstream and added to Aries Capital in sipping a latte. Nice. It almost hit a milestone, but we'll have to stay tuned. Lashinsky here, BM Lashinsky hit a new portfolio high. Congratulations. Caesar's in the building. What's up, Caesar? Let's see. Striper Kid bought nothing this week, just saving up some dry powder. Yeah, so it sounds like you and I, Striper, are kind of running on a similar playbook right now. Let's see. Pat selling T-Row and stacking some cash. Okay. There we go. Jack says, I reached $90 in dividend income. Not much, but it's a start. Absolutely. That's incredible. You're almost at $100. And, you know, that $100 grows to $200 very quickly, and then $500, and then $1,000. And I've said it once. I'll say it probably a million more times in my lifetime, probably more. But dividend investing, even though it starts out slow, and you start out with you know, some of those numbers, it is one of those things that just gets better the longer you do it. I call it the gift that keeps on giving, and it's so true. You know, I've been doing this for just about 5 years now, and I can say from experience so far, from my limited experience, that has definitely turned out to be true. And I'm more stoked about dividend investing today than I was when I first started, and I was hooked pretty much immediately. And now this month, like I won't I don't go on too much of a tangent, I guess, but this month is actually going to be a record month of income. And that's not this month, next month in September. And that's the other cool thing about it. You know, along the way, every couple months, every few months, you're met with a new milestone or another small victory. And you have to celebrate those whenever they do occur, which is why I like to ask you guys, you know, what's cool, what cool has been happening in your portfolio. It's fun to share that stuff. So, nice. Lashinsky, 1,000 SCHD shares. That's very incredible. Journeyman's in the building. Journeyman, I feel like long time no see. Maybe you were here last week, but yeah, it's good to see you. Good to see you, my friend. Sir Dude Broman's in the building. Sports Breaks, first time here. Welcome aboard. Hope you enjoy the live stream. Okay, Marcus has his fantasy football draft in an hour. Well, that's perfect timing. You know, we can talk some stocks for a bit, and then you can go. What are some fantasy football terms? You can. I know. I'm not even going to try. I was going to say something about the waiver wire, but I'm not even going to try. That is not my wheelhouse. Let's see. This is pretty crazy, guys. So Shane hits. Okay, I thought it said bought 11K, but hit 11K. That's still cool. Bought SCHD, DGRO, and SMH, trying to get to 12.5K before the end of October, which is my 1-year anniversary in the stock market, dude. That's crazy. So hit 5 figures in your first year. That's very impressive. Great job. Let's see what else we got. And what do you think of GES? I'm thinking of selling it since it went up. What is GES real quick? Oh, guess. Huh. Yeah, well, you know what? Let's take a look at guess. We'll save that one. We'll circle back to that. Can you look up WFRD when you get a chance? Weatherford International. That logo looks familiar. Yeah, we'll take a look at it. Save that one. Let's see. Good question for a fishy man. What do you guys think about this? Just picked up some SCHD. Been trying thinking all week about locking in my 3M gains. I'm up nearly 50% on the position. What do you guys think? It's hard to say. Like it's really hard to know what. I mean, I'm definitely not going to give you a definitive answer on whether or not you should sell it or hold on to it. But I will say that the answer depends. First and foremost, that's something that only you can answer yourself. Second, it really just depends on what you think the future outlook of the company is. If you think 3M is going to continue to grow and be a better business in the future than it is today, then maybe it's possibly worth holding on to. But that also depends on what else you have in your portfolio and the other places that you're considering allocating that money, because you kind of have to weigh those options against each other as well. I don't know if that was super helpful. Like I said, it's not going to give you like the straight answer, but hopefully that helps frame how to think about it. Yeah, Striper Kid wants to look at waste management. We can definitely do that. Let's see. This is a good question. So when do you feel like you can buy a Rolex? How much should someone have invested or saved before buying a luxury watch? I don't know. How much should someone have saved before buying a luxury watch? I think generally speaking, you should have enough saved, not so much invested, but I think you should have enough saved to where doing so is not going to diminish all of your savings. I think you need to make sure that you still have your emergency fund, your rainy day money, in case of emergencies, in case of the unexpected. And if you can save on top of that for something like that, then yeah, why not? And I think too, like it should be straightforward enough to set aside money specifically for that. You can like, for example, if you had a savings account, a high yield savings account. I know an Ally Bank, for example, they had this thing called buckets, and I could deposit money into that account, just one account, but then I could segment that money based on these different buckets. So in there, I had, like my car savings fund, I had our travel fund, I had emergency savings, I had all those different things. And so you could set up something similar. Doesn't have to be exactly like that, but somehow you can compartmentalize your savings and intentfully save for a watch. Set aside $100 a month or however much you want to set aside every so often until you have enough saved for that particular watch. That's how I would do it. And also don't let it take away from your investing and from your emergency savings. I think you have to be able to, you should be able to do those things as well while simultaneously saving up for this other thing. Okay, let's keep going though. Yeah, there you go. There you go, Journeyman. Nice. Vasco says reach 25K around 25K savings and investment. Started late, but let's enjoy this journey. There you go. Amen to that. Caesar's in the building. We bought our Norm SCHD and SCHG and VOO and added Constellation Brands and Next Air Energy and sold Nike. Interesting. Yeah, well, let's take a look at STZ as well. Because that's kind of an interesting one. They're the company that owns like Corona and I think Modelo. We'll take a look at them. They might not own Modelo. I kind of feel like they do. Anyway, we'll look at it. Okay. Oh. Okay. There's a good question from Ty here about reinvesting dividends, so we'll check that out. Mr. J, do you have an HSA account? No, I don't have an HSA account. Oh, interesting. Good insight. Sports Breaks has a good question about SCHD. I actually disagree with this right here. I don't think that you should buy watches with the intent. I don't think you should buy them with an investing lens. I think you should buy them to enjoy them and not think of it as an investment. It can be, but I wouldn't prioritize that. I wouldn't prioritize that when making your decision. Christian wants to look into Canadian Pacific. We'll check that out. Okay. Yeah, good question about 401ks. We can check that out. Okay, I'm actually all caught up in the chat, guys. So let's go through some of these stocks. So we're going to start here with Jax. Jax wants to look at Guess GES, thinking of selling since it went up. So, and Craig gave some good insight. They're being acquired for 16 something a share. So let's go over here. There. Okay, so let's go back to Guess GES. And guys, what we're taking a look at is Snap Stock. You can start using this for your stock analysis and research. There's a link to it in the description. Here with Guess, so they definitely popped upon the announcement, and it looks like they came up to about where they'll be acquired. So let's go back to Craig's comment here real quick. Where was it? Bear with me, guys. So Craig said, Guess is being acquired for $16.75 per share in March. Okay. So quite a ways away. So it jumped up to about the acquisition price. It's trading for more than that, and they just cut the dividend. Do your own research, but I would sell now. Yeah, okay. Still, let's take a look at the financials. 3 red flags. Actually, a pretty strong snap score. Not great in the dividend section, but growth looks good. Looks like the returns on invested capital, stuff like that looks good. Decent margins. Decent debt situation, but let's take a look at this. So yeah, it looks like growth. I don't know. I mean, I guess really the revenue growth is not impressive, but the earnings per share, at least since 2020, has been pretty good. 2022 to 2024 were very solid years. The free cash flow per share has been kind of all over the place. The general trend is up and to the right, but it's definitely spotty. Not very consistent. Margins actually are increasing. The gross margins, they've really jumped up there. I don't know. It's that's been consistent for the most part. Net debt to free cash flow has been pretty poor, except for 2024 here it went down to 3, which is good. Interest coverage has been okay, pretty good. So like Craig said, they did cut the dividend. What was the deal here? Did they pay out a big special dividend maybe? That's what I'm guessing. And here they paid out a big special dividend. Buying back a ton of shares. Okay, and I don't know why they're getting such a high score here. I'm guessing it's because the high returns on equity, and that's the only thing I could think of, because the returns on invested capital really are not that strong. So yeah, I would say that there's nothing really about this that jumps out to me that makes me interested in wanting to own it. Yeah, there's nothing really that jumps out to me about this. Oh, okay. So he said Guess deal won't actually close until Q4 2026. So even longer than I first thought. Okay. Okay, so that was Guess. Now Chris wants us to look up WFRD. Let's check that out. So that was what, Weatherford, right? So Weatherford International right here. Big drop in the last year. Really, really big drop. Down 10% year to date. Looks like 4 different red flags. I don't know. Growth looks good. Debt situation looks good. What does this company even do? So if we go over here, an energy company, okay, that provides equipment and services for the drilling. Okay, I see. Let's go to their website real quick just to see if we can get a visual. Excuse me. Okay, looks like they're doing a digital transformation. That's cool. who we are. Okay, well construction. So they make, okay. Interesting. They do, okay, they do a lot of different stuff. Okay, I kind of get the gist of it. Definitely different than an EPD or a Chevron or an Exxon, but could be a partner to those types of companies in smaller versions of that. So first red flag we'll see here is in revenue. It looks like revenue growth has declined, and it's really just going from 2015 to here. Over the last few years, since 2020, the revenue has increased, but it's still sitting about where it was at 10 years ago. So there's really not much, if any, growth in the revenue department. Earnings per share looks like it is trickling up. So that situation is getting better. Free cash flow is improving as well. So that looks pretty good. Gross margins are definitely increasing. That's really good to see. And since the earnings per share and free cash flow per share just became positive in the last few years, we're seeing an improvement in the margins there. Actually, really solid improvement in the free cash flow margin. Debt's looking good. Actually, debt's going down over time. The net debt is. So I really like to see that. Net debt to free cash flow looks to be in great shape. No surprise that they're getting such a solid debt score. I wouldn't worry about these red flags. Interest coverage still looks pretty low, though. I will say that. But the debt situation is improving. So I think that's more good than bad for sure. Okay, so they recently initiated the dividend, it looks like, according to this. Or maybe reinstated it. Maybe let's go over here actually, see if we can get some more insight. So WFRD, see if we can look at the dividend history a little more in depth. No, okay. So really, yeah, they really just started paying a dividend, but so far they've really made a big increase. Yeah, okay. What does the news say? What does the dividend increase news say here? 25. Okay, so they're paying $1 per year in dividends. So they must have, here's what happened. So they must have initiated maybe halfway through 2024 enough to pay 2 different dividends in that year. And then this year they're getting the full year of dividends, which is why it's showing this big jump right here. That's my guess. Yeah, payout ratio looks pretty good. Dividends very well covered so far. We'll see where it all settles out. I mean, the dividend is still so new. It'll be interesting to see where the yield ultimately shakes out, and the payout ratios and stuff like that with more time. So I don't know. I think it's okay, but kind of the same thing. There's really not much that's jumping out to me about this company. I like what they do though. Yeah, that's a pretty big job. But based on the charts, it's not really jumping out to me. The growth aspect's not really jumping out. Well, I say that, but then again, the free cash flow per share growth has been pretty solid. So yeah, I guess there's some good. I'd like this. I like the gross margin expansion. I like the diminishing debt. We'll see. The dividend stuff is TBD. Yeah, TBD. So we'll see. Not too bad though. Very high free cash flow yield. So with that and a very low PE ratio. So this is definitely a cheap stock. You can definitely call this one cheap. Yeah, so real quick, this question, this is about adding international stocks to my dividend portfolio tracking spreadsheet. So this really isn't something that I can control. Because the spreadsheet pulls data from Google Sheets or from Google Finance and also from FinViz, the stocks that the spreadsheet will accommodate, it's really at the mercy of those those two platforms, Google Finance and FinViz. So like I said, it's really outside of my control. The spreadsheet does work best with US stocks. In the portfolio walkthrough video, which you can find linked on the main page of the spreadsheet, towards the end, I did demonstrate how to add international companies, but not all of them are going to work. And like I said, it's really outside of my control, unfortunately. But anyway, moving on, guys. Striper Kid wants us to look at waste management now. Yeah, so really solid company. I mean, I've said this before, but I can't think of what could possibly disrupt a business like this. So, and interestingly, the snap scores, I guess, on the lower side. Profitability makes sense. I mean, I could see how it could be capital intensive, or the margins could be low. Real quick, let's look at RSG. I just want to see the snap score comparison. So 5.46 versus 5.93. So pretty similar. You're getting a slightly higher score with RSG. We have 4 red flags with waste management. It's up 10% over the last year. Over the last 5 years, pretty solid performance too. It's up 111%. So, and with that said too, I mean, as far as buying this stock and the valuation, it's one of those that just keeps getting more expensive as time goes on. The price free cash flow continues to go up. The free cash flow yield continues to go down. So as time goes on, you're getting less and less of a bang for your buck with this company. But with that said, it's been a very consistent grower. The thing about this business, it's all, I don't want to call it subscription based, but pretty much that all of their revenue is, most of their revenue is recurring. You're paying for, the garbage service every month or every quarter. And typically in the various cities, you're only going to have like 1, maybe 2 businesses that come and pick up your trash. Like here in Las Vegas, for example, it's Republic Services, it's RSG. And you don't really have an option, I suppose. In most cases, you don't really have an option. And what are you going to do? Not pay to have your garbage picked up? So yeah, this is a very, very sticky business. And so it's no surprise to see the financials just continuing to improve and the growth continuing to happen over time, from top to bottom, really. So, and like I said, I can't really think of what could come in and disrupt that. Now, with that said, we do see the free cash flow margin declining quite a bit. So you'd want to look more into exactly what's going on there. But yeah, that's a pretty noticeable decline in the free cash flow margin. So maybe there's some more CapEx going on. Maybe they're doing some investing, which could be a good thing, so it might not be bad. So with that, net debt has definitely increased, definitely taken on more debt. And I will say the net debt to free cash flow is pretty concerning. Very high. I mean, I would imagine pretty much all of this is long-term debt, so it's probably not as bad as it seems. But with that said, the interest coverage situation is getting worse. It's definitely diminishing here as well. Looks like in 2022 it peaked at about 9, that's a good number. I'd be happy with that. But since then it's really come down below that. Not a surprise. What was the score here? 2.5 for the debt. I think that's fair. Showing red flags on all of them. So yeah, I can't say that that's my favorite thing to see. As the stock has gotten more expensive, obviously the dividend yield has gone down. We're definitely seeing that here, but you're still getting a consistent dividend grower. Over the last 5 years, it's grown 8.3%. Not too much lower than that over the last 10 years. And, if these free cash flow growth trends continue to play out, I think we'll probably expect similar dividend growth, especially because the payout ratios tend to be pretty stable, except for the free cash flow payout ratio. We do see them increasing this over the last few years. So looks like it used to sit in the 40s, sub 50%. But as of late, it's jumped up into the 60s, jumped up into the 60s. So still room. It doesn't look like the dividend's at risk of being cut based on this, but it is higher than average. So that is a trend you'll want to keep an eye on. I don't think this is a red flag, really. So This one right here. So all in all, I think if you're looking for just I don't know, I think if you're looking for just a good long-term hold, a boring business that's at very low risk of disruption and becoming irrelevant, I think that's what this is good for. So yeah, I don't know. I think it's a good business. The tough thing about this one, like I said, is the big question is right now a good time to buy it? I want to say no, because it's just like, just continues to get more and more expensive. That's all this stock really does. But with that said, that's all this stock really does. So if you buy this today, over a long period of time, are you still going to be fine? Probably so. Probably so. It's just tough for me to look at a situation like this and think, yeah, it's a good time to buy it. But that's probably not the right way to think about it. So I think if you have a long time horizon, you planning on holding this one for a long time, then yeah, I think it's probably pretty solid. I think I'm more partial to RSG though. I think we're getting a lot more growth from Republic Services. I'm also more partial to this one because I am a paying customer of theirs, but I also do think the financials look better. Case in point, like look at the, well, interest coverage still is low. Interest coverage still is low, but the net debt to free cash flow is declining. So that's a good sign. The situation there does seem to be improving, even though they are adding more debt to the balance sheet. But same thing. I mean, you're getting a lower starting yield with this one. And this isn't accurate either. I don't know why it shows that. Their real dividend growth rate is about 7.5%. So really not too different from Waste Management. And the payout ratio is actually declining. So, and it looks like the returns on invested capital are actually kind of slowly trickling up. So I would be more partial to this one. So, and you're also getting a slightly higher free cash flow yield. So it's kind of a trade-off though, because you are getting the lower starting yield. So, okay. Osvaldo, thank you for the $2 super chat. That's really nice. What do you think about WY? I don't know that I've heard of that one. Let's take a look at this one. So this is quite the name. Weyerhaeuser. Okay. Okay, so this looks like it's a REIT. Right? So it's a specialty REIT. Oh, interesting. World's largest private owners of timberlands. Interesting. Okay, so okay. Huh. Okay, so they own forestry, campsites, maybe, wood products, huh? Like molding and stuff. Okay, lumber. Interesting. So it's not just a REIT then. They do some other stuff as well. Why is it being, well, I guess it's in the real estate sector, so that makes sense that it would be classified as a REIT. So let's ignore this for now, because that's not going to be the most fitting for this. It might be tough to look at this one on Snapstock. With that, I mean, we can see the revenues have been pretty flat. Let's go look at it over on Seeking Alpha. That might be better for this one. So WY. Okay. So yeah, showing some similar charting here. It doesn't show the FFO though. It shows earnings per share for this company over on Seeking Alpha. So, and the earnings per share has been going down. Does it show the free cash flow? I don't know. This one, it's tough to gauge it. But yeah, this doesn't look great to me. Yeah. This isn't looking good to me. Is the FFO per share, is that pretty similar to that chart? Yeah. So it's, yeah. So that's pretty spot on. Yeah, I can't say that I'd be too interested in this one. And the dividends are really all over the place. And it's not like you're getting like a high yield really either, right? You're getting a 3% yield. So yeah, I'm not too partial to this one. Let's actually look at this. Yeah, okay. I'd probably skip that one, but thank you for bringing that to my attention. I'm going to add this to the watch list to keep an eye on it because I'd never heard of this company. And then what was the last one that we looked at? It was Weatherford. Let me add this one too over here. Okay. Okay, guys, let's go back over here now to, let's see what Vasco has to say. The monthly data tab on the spreadsheet, in the market value at the end of the month, you put your investment. No, you'll put your full portfolio value. So what he's referring to, guys, so over on the spreadsheet, over on the monthly data tab, I actually need to update mine, I think, for this last, for July, and also for August here pretty soon. So what I do is I just every single month I'll look at my monthly brokerage statement, and it will show you your balance at the start of the month and your portfolio balance at the end of the month. In this market value cell, or in this column, I put the ending balance for the month here for the market value. So I do that for both my taxable account and also my Roth IRA. So all of the information that goes in the monthly data tab, I just get from my monthly brokerage statement. So it tells me exactly how much I've contributed. It tells me my starting balance, my ending balance, and I just put that right here on the monthly data tab. Hopefully that makes sense. Tony's got a good question. So, okay, this is a good question here from Ty here. Says, is it better to reinvest all dividend paying stocks? Okay, I might need to read this one a couple times. Is it better to reinvest all dividend paying stocks for the long-term compound annual growth and stop the reinvestment for those annual payments when you need the cash and are closer to retirement? Yeah, so in a nutshell, Ty, that's essentially how it goes. The general rule of thumb is until you are in a position where you need to use those investments to pay your bills, or, unless you need that income to pay your bills, just reinvest it. There's no other reason not to. And the big reason that you want to reinvest all your dividends is because that just helps give the snowball effect a boost. That is, in a big way, the snowball effect is reinvesting your dividends. You get paid a dividend, you take that, you reinvest it. Then the next time you get that dividend from that company or in your portfolio, it's going to be even larger. And then you take that and reinvest it, and then it creates that snowball effect. And so, if you take that away from your portfolio, if you don't allow it to be reinvested to go and buy more shares and then pay you more income, it's really going to it's really going to handicap the growth of your portfolio, and it's really going to slow down the compounding effect. Now, you can still grow through other means, through your contributions, through the share prices of your stocks going up, and also as far as the income goes, you can also benefit from dividend growth from the companies actually increasing their dividend payments. But the reinvestment of the dividends is a big one. That's a big piece of the puzzle. And over a long period of time, over 10, 20 years, the longer you go, the more of an impact it has. It really makes a big difference. So yeah, the general rule of thumb is, if you are, and I probably should have saved that comment because it was really good. Here, let me go back. Sorry, and find this. But yeah, the general rule of thumb is, unless you need that income to pay your bills, just reinvest it. Where was that? Sorry, guys, bear with me. Almost got it. There it is. Okay. Thank you for the great question. You guys are asking some good ones tonight, and I appreciate it. See, I knew this was going to be a good stream, guys. What do you think? Is this the best one yet? Did we reach that T-boy status? Mm-hmm. This is a good point too. Sticking to the reinvestment of dividends, this is a good point. So Striper Kid says you can take the dividends in the form of cash. So basically, you can choose to not automatically reinvest them in the stocks that paid them, and decide to either use the cash or invest into something in your portfolio. And that's what I do in my portfolio. I don't automatically reinvest my dividends back into the positions that paid them. For example, whenever I get paid from Realty Income, that dividend doesn't automatically go back to buying more shares of Realty Income. It's totally fine to leave the drip on. But I've personally chosen to turn mine off and do like Striper Kid here says and collect that as cash. But still, all of my dividends get reinvested back into my portfolio. So once I get that dividend, it one way or another, it's going to go back into the portfolio and buy some sort of stock, you know. So let's see. Let's go through. Oh, that's an interesting question from Horatio. That'd be kind of fun. So this is a quick one, actually. Horatio says, I'm starting in club at my school that correlates with investing. Is it possible for somewhere in the future, in 1 month or 2 months from now, can you hop on a Zoom call and talk to the members? Yeah, I totally would be down for that. I don't know that I'd put together like a presentation or anything like that, but I'd be more than happy to hop on and ask, or hop on and answer questions and talk to your club members. I think that's a really cool thing that you're doing. And I wish when I was in school, I had either started something like that or been a part of something like that. So Sir Dude Broman's got a good question about the Roth. Head and Hands Consulting, $2 super chat. Thank you so much. TLTW only for the next 2 years. So basically bonds for the next 2 years. Is that, are you saying that's what you're doing, or what's the, I guess what's the context here? I'm sorry if I'm missing that. And thank you again for the super chat. And we'll get back to some of these saved questions here in just a moment, guys. But yeah, what's the context here? I think maybe what you're saying is I'm just going bonds for the next 2 years. Yeah, Joe's got a good question too. While we're waiting for Head and Hands to respond. SCHD and SCHG, all I need for ETFs. Should I add VOO or not because of overlap? That's a good question. Yeah, I think you'd be fine with just those two. Let's actually look real quick and see. Let's actually look real quick and see what the overlap is between SCHG and VOO. This is cool. I can just show you guys the ETF overlap tool we have here on Snapstock. I don't know if I've shown you this before. Okay, so on Snapstock, if you just search an ETF, we need to add the dividend stats. I think that's the next addition to this. I'm thinking out loud. Okay, so you can go down here to the ETF overlap section. So we want to see how much overlap there is with VOO or the S&P 500. And yeah, it shows there's 57% overlap, which is a decent amount. It's not an incredible amount that it's kind of a deal breaker and that you can't own both, but you'll definitely be double dipping. And if we look at the overlapped holdings, it's not much of a surprise. I mean, you know, it's going to be the usual suspects, the Mag 7s, the NVIDIAs, Microsoft, Apple, Amazon, Meta, you know. But it'll show us actually all of the overlapping holdings. So, but some of these are such small, most of these are such small positions. The only really meaningful ones that have a lot of overlap are going to be the ones on basically these first couple of pages, I'd say. But even so, that's not really the end of the world. So yeah, I think there is room to own both. And one thing while we're looking at this, guys, this is actually color coded. So if the overlap is yellow like this, it means there's moderate overlap. If it's green like it should be with this, there's minimal overlap, none at all in this case. Or if it's red, if it's red, then yeah, a lot of overlap. It's kind of cool little feature. So Jack Murphy, what's up, Jack? Good to see you, man. Okay, so yeah, Roth IRA, TLTW, what do you think? I think it just depends what I mean, you mentioned 2 years. You're going to do that for 2 years. My next question would be why? Like why, I guess, why would you be considering that decision? What's the reasoning for it? Because I think if you, like I said, I don't know what your time horizon is. I don't know how close you are to retirement, but I think if you have a long time horizon, it makes more sense to be just in equities, in stocks. But like I said, if you are nearing retirement and feel like you need to be a bit more protected, then I think there's more of an argument to be in bonds. I'm guessing probably part of the reason that you're thinking about going into bonds for these next 2 years is because you're thinking that the market's too frothy right now. We're reaching a peak and that there may be a serious downturn sometime in the next 2 years. In which case, I don't know. I don't know that I have a good opinion about that. I'm kind of like, my knee-jerk reaction to that is to say, don't try and time the market, because you might be right, but you could also be wrong, in which case you'll have missed out on a couple years of gains. So it's kind of a gamble in that regard. But I'm more inclined to lean towards that and say don't try to time the market. So, but I would agree with you, though. I would agree with you in saying that the market is pretty frothy, and at some point, like, something's got to give. I just don't know when that's going to be. So, okay, let's go back to some of these questions, guys. We've got about 15 minutes left here in the stream. So this next one is from Sports Breaks. Is SCHD a good buy with rate cut possibility? I noticed some stock days. My momentum stocks go down and my dividend stocks go up. I've been noticing that too, actually. Thinking of buying more dividend stocks with the way the market shifts. So the thing about SCHD, it's very out of favor right now. If you spend any time with your head in the market, watching YouTube, spending any time on Blossom, on Twitter, people are not very happy with SCHD because of its lackluster performance over the last, I don't know, in my opinion, like a short time horizon. Craig has actually, I don't know if Craig's still here in the stream, but Craig has talked about this at length, and I think he's just very spot on with it. And when it comes to SCHD, through all of this, through thick and thin, I've continued to buy it every single week and every single month, no matter whether it's up or down or rain or shine. And I think when it comes to buying ETFs in general, whether it's SCHD or VOO or SCHG or VYM, or you insert ETF here. When it comes to investing in ETFs, I think the beauty of them and the purpose of them is to not have to think about stuff like this. Is XYZ a good buy with rate cuts? I think that the whole point of buying into ETFs is to just automate the process and not think about it. And when it comes to buying ETFs, that's what I would encourage you to do. Don't worry about what's going to happen with rate cuts. It's, in the grand scheme of things, the rate cut decisions today are not really going to matter all too much. If you think SCHD is if you resonate with the fund's objective, if you like the holdings, if it's in alignment with your overall investing goals, then I'd say buy it. If it's not, then don't. But I wouldn't worry so much about what's going on with interest rates and use that as any sort of reason to or not to buy SCHD or any other ETF. So hopefully that makes sense. TLTW is long-term bonds, right? Am I thinking of something else? No, I'm right. Long 20, long. Yeah. I see some chatter in it about the some chatter about it in the comments. Okay, yeah, it's the 20-year bond ETF. Down 15% in the last year. Wow. Yeah, and it's really dropped. Holy cow. You're right, Chris. Good question about UPS case, and we'll check that out real quick. Okay, so Christian's got a good question here. Are you able to take a deeper look into Canadian Pacific? For me, I'm seeing a solid company with solid financials that are growing. However, it seems to only be going down. Am I missing something that you see? Let's take a look at it. So let's go back over here. How's this? Okay. So it's down 8% in the last year. Over the last 5 years, it's only up about 28%. Okay. So over the last 5 years, it looks like it's mostly traded pretty flat, right? It's had its highs and lows. You definitely see a little bit of choppiness, but it doesn't seem to trade in too volatile of a range. So I wouldn't expect any crazy appreciation from this one. Let's see what it looks like over the last 10 years. Yeah, I mean, even the last 10 years, I'd say it's not been super outstanding. Really solid rebound post-COVID, but since then it's been stuck. With that said, the valuation is kind of interesting. The PE ratio is considerably lower than it has been over the last 5 years. The free cash flow yield is quite a bit higher than it has been over the last 5 years. So maybe based on that, just based on its historical valuation, maybe it could make sense to consider it as a cheap stock. But that begs the question, just because it's cheap or cheaper than usual, is it still a high quality company? Is it still one that you want to own? Looking at this, we have 6 red flags, snap scores 5. We're getting some pretty solid scores in growth and profitability. Debt's not looking good. Dividends and buybacks, not great. Capital efficiency, same. The growth has been pretty solid. I will, like, from top to bottom, I do like this. I like what I'm seeing here. Some choppiness here with the free cash flow per share, but overall it's up and to the right. Revenue growth has been really nice, especially these last few years. Earnings per share has been good. Looks like margins, the gross margins have definitely taken a hit these last couple of years in a big way. So I would look to see like why their costs have gone up so much here. Yeah, it looks like the net profit margin has taken a hit too. So I'd look and see why the higher costs. Big jump in debt coming out of the pandemic, and it doesn't look like they've really worked on paying that down. Net debt to free cash flow is a bit high. Interest coverage ratio is low. So I don't really like this. I think that you can find, just kind of thinking out loud for a sec. I mean, I guess all of this is thinking out loud. I think you can find companies that have just as good, if not better growth, just as good, if not better margins, with a more favorable debt situation that's also in the industrial sector. Maybe not as cheap, maybe not seeing as much of a pullback lately, but or over the last year or whatever. But I think there are probably better options out there, especially considering you're getting a less than 1% yield and a not great dividend growth rate. And according to this, I mean, is that right? The dividend has gone down. Oh yeah, it looks like it. Yeah. Are they paying some special dividends in here? No, actually. So yeah. Wow. Okay. So for the last 3 years in a row, the dividend's gone down. Yeah. So yeah. And they issuing a ton of debt, issuing a ton of shares. The dividend does still look to be well covered, but I don't know. This isn't really jumping out to me. Like I said, I think you can find better dividend payers also in this sector. I mean, I feel like I've been covering quite a handful of them lately. In fact, if we go over to my watch list on here, let's show some examples. These aren't going to be railroads, but just some examples of companies that I think are better in the industrial sector. And some of these actually are seeing a pullback. Some of these are seeing their share prices come down. If this will load, I might need to refresh the page here. Bear with me, guys. 1 second. It might not load. Of course. Okay. There we go. Okay, so like front and center, let's actually do this. So A.O. Smith is in the industrial sector. This company does, what do they do? It's like refrigeration and water heaters. That's what it is. Okay. I was confusing it with Watsco. So they do water heaters, stuff like that. Their share price has definitely come down. Badger Meter is a great company, very boring company, also in the industrial sector. What else? I mean, I don't think Motorola's in communications. Old Dominion, I think, is a much better pick. And it's actually like somewhat similar to something like a Canadian Pacific. Old Dominion's in trucking. It's kind of adjacent to railroads. PACCAR, I think, is a pretty interesting business. They manufacture trucks like Peterbilt and stuff like that. Pool Corporation, I think that's a better looking buy. Rollins, obviously, you guys know that one is near and dear to my heart. Excuse me. Near and dear to my heart. And WD-40, this one's also seen quite a big pullback lately. Down 10% year to date. Watsco, for sure. The thing about Watsco, though, is their payout ratio is really getting up there. So like I said, overall, there's a handful of other stocks in the sector that I personally think are more attractive. So, okay, guys, we've got a few more comments to go through here, but real quick, we've got a $10 super chat from Alfredo. Thank you, man. Thank you so much. Thanks for making the last almost an hour of work more enjoyable for me. I'm matching every dollar I give you in Ari with my parents' retirement account. That's awesome. Thank you so much, man. Really appreciate the super chat. And yeah, so Alfredo, I believe, is managing his the investments for his parents, which I think is a really big responsibility. But I also think that's really cool of you to take that on and help them out with that. So keep up the good work, and thank you again. AOS was hot water heaters. Yeah, AOS and Watsco, pretty similar businesses. AOS, like I said, does water heaters and stuff like that, but Watsco does HVAC and refrigeration. Both distributors. I think AOS is a distributor. Oh no, they're a manufacturer. They manufacture and market residential and commercial gas, heat pump, and electric water heaters, boilers, tanks, and water treatment products. I did a video on it a couple months back. Very high snap score too, 7. Only 1 red flag. Okay, sorry guys, I'm getting sidetracked here. So let's go to hot water tanks are being phased out. Yeah, they're mostly tankless now. You're right. That's a good point. So Crypto King Freddy, at any point, is it okay not to take employer's match for my 401k? My 401k options are horrible, but I could put that money in my Roth and make way, way better returns. That's a good question. Let me know what you guys think about this too. My first question, kind of in response to this, is do you at least have access to the S&P through the 401k? And I don't know, maybe give us some color on what the options are and why they're bad. I think that would help. But, you know, I would say, I mean, I would still encourage you to take the match. I mean, if you can, I mean, sorry, I'm getting sidetracked again. I would encourage you to take the match because it's basically free money. And I don't know exactly what they're matching you or what the maximum is, but it's like, why not? Like, why not take advantage of that? Um, yeah, I think it makes sense to take the match. I can't think of any instance why you wouldn't want to. I'd be surprised if there wasn't at least like a 401, like a 401 or not a 401, like an S&P 500 option. Maybe there isn't though. So that's my take. I would say take the match. Why not? It's free money. So, and it also, you do get the slight benefit of this actually ties into Sir Dude Bromance question. You do get the slight benefit of the tax deduction for all your contributions. So okay, so but yeah, getting into this one, kind of similar question. I'm a fan of the Roth IRA, but I'm curious how much better than a 401k a Roth IRA is. What do you think? So, a couple of differences. I mean, the big difference is the tax benefit. We'll get into that in a sec, but another benefit to, and I would call this an advantage that the 401k does have, is that your contribution limit is way higher for like the maximum contribution it looks like is 23,500. That's more than 3 times what you can contribute to a Roth IRA every single year. So I think that the 401k gets the point for that. But like I said, the tax efficiencies, the tax benefits from both are just different. They're kind of the opposite of one another. With the 401ks, the amount that you contribute can be deducted from your taxable income, so that can help lower your tax bill. But then on the other side of that, you still have to pay taxes on the profits and the dividends and anything else that's in the 401k when you do pull it out, just like you would in a taxable brokerage account. So I do think that is a bummer. As opposed to the Roth IRA, you don't get the tax benefit up front. You don't get to deduct or subtract your Roth contributions from your taxable income, but you do get to benefit from the tax-free profits and dividends down the road when you go to retirement. And personally speaking, I would rather get the tax benefit later on. For me, I think it's going to be more beneficial, and probably the benefit will be more substantial, especially as time goes on, to not have to pay taxes on profits or dividends in retirement. So I'm probably more partial to the Roth, but I don't know. I think if you can do both, why not? Especially going back to the last question, especially if you have an employer who's willing to match your contributions. I think they both have their pros and cons, and I don't know. That's just what it boils down to. Hopefully that answers the question. And that's actually, I'm going to save this one for the future. Be good to put in a newsletter. Okay. Yeah, Tony's got a good question here. And this one gets brought up from time to time. And by the way, guys, after this, we have 2 questions left, and then we'll wrap up the stream. But Tony wants to know, have you ever thought about just sticking everything into an ETF? Yeah, I definitely have had that thought. It's one that I have from time to time. It would certainly be much easier to just, kind of take the approach that I have in my Roth IRA and apply it to the rest of my portfolio, which is just, half SCHD, half VOO, call it a day. But the thing is, I, at least for now, I'm really enjoying what I'm doing. I really, investing is one of my hobbies. I have a lot of fun researching companies and talking about them, and, trying to pick the ones or putting money into the ones that I have the most affinity for. And and it's been good to me too. Like the returns have been good. I've outperformed the S&P so far. I don't know if that will continue, but so far, all across the board, it's been a good thing for me. And I've learned so much from taking this approach that I wouldn't have gotten if I just put it into ETFs and called it a day. The experience has just been different. And so there's been different learning experiences from that. And unless that changes, unless I stop having fun with it. And unless it stops being, the returns stop being good, I don't see myself just going all in on ETFs, especially at this point. I feel like I'm in a really good place with my portfolio, where I don't know. I just feel like it's really coming together, and that's the beauty of this style of investing is once you do own these positions that you plan to hold for a long period of time. Once you have them, there's really not much like heavy lifting you have to do from there. You do have to do some maintenance in terms of just keeping tabs on them and going through the earnings calls and stuff like that. But I enjoy doing that stuff. I enjoy spending time doing that and, keeping up with all of these businesses that I'm actually interested in and care about and like, and, as long as that continues, I'll keep it going. But if that ever were to change, then I would have no problem just going all in on ETS and just, kind of making things easier on myself. But I don't really have any plans on doing that at this point. So really good question. It's always a fun one to answer. Oh, we actually just have one more comment here. This one's from Kaysen, who says, is UPS a lost cause? I got it at 115 and I'm just not ready to get rid of it yet. What's it at right now? 87? I don't know. It's hard to say whether or not it's a lost cause. I don't think so. But I would be surprised if UPS didn't cut their dividend. I'm going to leave that there. And I will say, I've been putting together my just the videos that I'm planning to make in September. One video that I'll be putting out, actually, I think like next weekend is going to be on UPS. So I'm going to try and go through like a full analysis of UPS. Just talk about the financials, talk about some of the qualitative aspects of it as well, and hopefully that'll give you some more insight on that question there. So, but yeah, I'm UPS is a tough one right now, I think. Okay. So guys, I think this is a pretty good place to wrap it up. 6 minutes over the hour, unless there's any last second questions, last quick ones from you guys. I think this will be a pretty good place to wrap it up. Yeah, the enemy of everyone is taxes. I actually have a question for you guys before we go. Thoughts on Nike? Man, I feel like I talk about Nike every live stream. I will say I would be surprised if we existed in a world without Nike anytime soon. It's a business that I'm not particularly interested in owning, even though I have like all my running shoes are Nike, and I've been very happy with them. I don't see myself switching to a different brand. But from an investment standpoint, yeah, I think retail's tough. I even think when you are investing in businesses that have such a strong brand like Nike does, I think as far as competitive advantages go and as far as moats go, I actually think like the brand power is kind of a weaker one. And the more that I think about it, the more that I think that it's brand equals reputation. So a company's brand is the company's reputation. And it takes a long, long time to build up a good reputation, but it's also a pretty easy thing to destroy. You can destroy reputation or sour your reputation much quicker than you can build it up. And I think we've seen that happen with actually numerous big brands. I think Nike's kind of been one of them. I think I mean, they're still surviving. They're still profitable, but I think Nike's been one of them. I think it's possible that Starbucks has been another one as well. And so, yeah, I will say as far as competitive advantages go, as time goes on, brand is one that I'm less inclined to put a lot of weight into just because it can be easy to screw up. So, oh yeah, there was one last thing. I had a question for you guys. That's the last question of the night. I do have one for you guys. So what do you think next week? Monday morning, we're going to open up red Or are we going to open up green? Is the market going to be up or is it going to be down on Monday? Let me know your thoughts here in the chat. Let me know what you think. This week, I think we opened up red on a red note. But we've had some good days and bad days this week. Andrew says red. Oh, market's closed because Labor Day. You're right. Tuesday. Let's go with Tuesday. Yeah, you guys are right. So let's go Tuesday. Tuesday, it'll open red. Sigurd says green. Fast Eddie says green. Shane says red. Mitchell red. Kyle red. Red from Chris. Jake says green. Andrew says green. Insider sources say green, Jack. Nice. We need to embrace some red. I know. I agree. Praying for green, probably red, knowing my luck. Bringer of Dividend says red. Sir Dude Bromance says we're going to open up confetti colored. Yeah, Michael says red. B-Cat says flats. Bernard says red. Joe says greed. Phil says red, green. Hopium for good news on UNH. There you go. Sir Dude Bromance says green. Yeah, I'm with you though, Striper Kid. I'm with you, man. I really think we could use some red. Pretty frothy. I'm happy to see some stocks in my portfolio doing well though. Like I'm not planning on adding more to Zoetis right now. I'm not planning on adding more to Clear Secure. I think both of those positions are sized about where I want them. Zoetis actually may be a bit too heavy. So those type of positions, I just hope they keep going up. I'm totally happy with that. But I would not mind seeing a pullback in stocks like Vici. Honestly, I would not mind seeing Vici come down. I would not mind seeing EPD come down. Lowe's, I wouldn't mind seeing that. Procter & Gamble wouldn't. Snap-on, I am dying to see them come down. I am dying. Williams-Sonoma's kind of been interesting. In hindsight, I wish I would have bought this one when it hit about it was in the 130s not too terribly long ago, like earlier this year. And I think if the share price ever gets back down to like around 150 or below, I'll probably start buying it again. So I would not mind just seeing Williams-Sonoma come back down. They just had a really, really good earnings call. Really happy with their results. So there's a few positions. Honestly, Rollins too. I'd love to see Rollins come down. Visa, yeah, absolutely. Visa, for sure. For sure. Yeah. I should make a video soon on because I've got a few positions that I'm really kind of keen on right now. Old Dominion's still one of them up there for me. Now's not a bad time to buy Old Dominion. I really should. I've been thinking a bit more heavily about that one. I think now could be a good time to buy it, but I think there could be some more weakness for them in the short term. So I'm kind of waiting. Motorola Solutions, MSI. Yeah, I'd love to see that one come down too. I would say my top three right now: Motorola, Old Dominion, Rollins. Top three. Casey's General Store, I want to see them crash because I would love to buy that stock too. So yeah, and that's true. Maybe we need to wait a little bit and see how things play out. So all right, guys, I'll keep going for another hour if I don't stop now. But with all of that said, thank you guys for a really fun stream. Yeah, really fun stream tonight. I was really looking forward to this one, and I felt good coming into it. I knew it was going to be a good stream, and I get you guys to think. I have you guys to thank for that. So thank you. Hope you all have a great weekend. I've got my monthly dividend income video coming out first thing tomorrow morning, so definitely tune into that. Pretty good month of income. September is actually going to be pretty crazy. I'm talking about that in tomorrow's video as well. So definitely tune into that. Otherwise, I hope you guys all have a great weekend. Stay out of trouble, and I'll see you in the next one.